Hello and welcome back to the Deep Dive. It is Wednesday, February 25th, 2026. And if you are listening to this in real time, you might want to check your portfolio apps right now because the ink is barely dry on the report we are about to discuss today.
Yeah, it really is hot off the press. I mean,
Yeah.
I've still got the digital highlighter marks fresh on the PDF we're looking at.
Today is, well, it's the grand finale, really. We have been on a very specific, almost year-long journey with this company. For our longtime listeners, we haven't just been watching the market generally. We have been tracking the narrative arc of a public bank, PBBANK, like it was some kind of prestige TV drama.
Right.
We started back in 2024 looking at that massive acquisition of LPI Capital. And then we checked in during Q1 of 2025 when things were looking surprisingly rosy.
Suspiciously rosy, some might have said at the time.
Fair point. Suspiciously rosy. And then we had that absolute nail-biter in our Q3 deep dive regarding the OPR cut. And now here we are. The full financial year 2025 report for Malaysia's defensive giant has just dropped.
And what a year it has been, honestly. It's rare that we get to track a narrative like this quarter by quarter. Usually, financial analysis is a snapshot. You look at the numbers, you make a call, you move on.
Yeah.
But watching Public Bank navigate 2025 has been like watching a very slow, very high-stakes chess match against the global economy.
That is the perfect way to put it, a chess match. And the question on everyone's mind, the core question we are trying to answer today is this. After the turbulent 2024, after the interest rate cuts in mid-2025, does public banks still hold the title of defensive giant? Or has that famous, arguably boring consistency finally hit a wall?
It's the ultimate stress test. I mean, we've seen them through the goodwill impairment shocker 2024, which we covered extensively on the Night Eyes YouTube series. We saw the optimism in Q1 2025. Then we saw the margin squeeze fears in Q3. Today, with the Q4 and full year numbers, we finally get to see the scorecard.
I really love that you brought up the Night Eyes coverage because our listeners might remember that specific analysis. Back in 2024, we did a deep dive into the growth strategy and that massive impairment charge from Hong Kong. Then, in Q1 2025, we titled our discussion Strong Growth and Strategic Insights because, honestly, they came out of the gate swinging.
They did. They had incredibly strong loan growth right at the start of the year, defying the odds that everyone was laying out for them.
But then, and this is crucial context for today, we had our Q3 2025 deep dive. The title was, Is Malaysia's Defensive Giant Still Strong? We were genuinely worried about the overnight policy rate, the OPR, being cut in July 2025. We thought it might just absolutely crush their margins.
Exactly. And that brings us to today's mission. We aren't just reading numbers off a sheet. We're unpacking the Q4 2025 results to see how they finish the race. We're comparing the full FY 2025 against the previous year to see if the growth is real or just accounting magic. And finally, we're going to revisit our financial Moat scorecard.
Yes, the scorecard. In Q3, you gave them a 9 out of 10, a very high score. We need to see if that stands after today's data.
It's a high bar to clear, so let's see if they managed it.
All right, let's jump straight into the headlines. Segment 1, the headlines. It is February 25th, 2026. The report is out. What is the headline number for the full year 2025?
So the headline is record profits, but with a massive caveat on the growth rate that we really need to dissect. For the financial year ended December 31st, 2025, Public Bank recorded a pre-tax profit of RM 9.54 billion. That is up 6.8% from RM 8.93 billion in 2024.
RM 9.54 billion. That is a massive number. I mean, we are inching closer and closer to that RM 10 billion psychological barrier. That sounds incredibly impressive on a billboard.
It does. But let's look at what actually lands in the shareholder's pocket. If we look at the net profit attributable to shareholders, which is, what really matters for the stock price and dividends, it hit RM 7.22 billion. That's up about 1.1% compared to 2024.
Okay, let's pause there and really let that sink in. Pre-tax profit is up almost 7%, but net profit is only up 1.1%. That feels a bit modest. In fact, depending on which inflation index you look at, that might be flat in real terms.
It is modest.
Yeah.
And that is part of the mature stock narrative we discuss so often on this show. You aren't buying Public Bank for it to double in value overnight like a semiconductor stock.
Yeah.
But to be fair to them, we have to look at Q4 specifically to understand the momentum. If you just look at the yearly average, you miss the actual trend.
Right.
In Q4 2025, just the last 3 months, net profit rose approximately 4.3%. to RM of 1.8 billion, compared to RM 1.8 billion in Q4 2024. So they finished the year with a bit of a sprint.
A sprint is good. It's certainly better than limping across the finish line. And what about the top line? Are they actually bringing in more business, or is this just cost-cutting and firing people to save pennies?
No, the business is genuinely expanding. Operating revenue for the year stood at RM 29.5 billion. That is up significantly from RM 27.2 billion in 2024. That is legitimate business expansion, selling more products,
Nice.
signing more loans.
Okay, so revenue is up, profit is up. But why? What is driving this? Because we know the economy hasn't been exactly on fire, and we had that interest rate cut in July that we were so intensely worried about.
This is where we have to peel back the layers. There are three main engines here. First, net interest income, or NII. Despite the headwind of that 25 basis point OPR reduction in July 2025, their NII actually went up by 2.4%. That's an increase of RM 265 million.
That is surprising. Usually when interest rates get cut, banks make less money on loans because they have to lower the rates they charge borrowers. How did they increase income with lower rates?
Volume. Pure and simple volume. Think of it like a grocery store selling apples. The price of apples drops, so they make less profit per apple. But because the price dropped, people bought way more apples. Public Bank lent out so much more money, they grabbed so much market share, that it compensated for the slightly lower margin on each individual loan. It's the defensive giant flexing its muscle.
Fascinating. So they made up for margin with volume. That essentially means they are stealing customers from other banks, doesn't it?
Ideally, yes. Or they're finding new borrowers in a market where others are afraid to lend. They have the capital to do it.
What's the second engine, then?
The second engine is the real star of the show, honestly, non-interest income. This is up a staggering 14.7%. That's an extra RM 419.5 million in the bank's pocket compared to last year.
14.7%. That is not boring growth. That is almost tech stock levels of growth for a traditional bank. Where is that coming from? Is that the insurance business we talked about?
Precisely. That is the LPI Capital acquisition paying off, plus higher investment income and unit trust fees. They are successfully diversifying away from just relying on interest rates. This really validates the strategy we questioned back in 2024.
It really does. It seems like that acquisition, which had some skeptics at the time, is now doing exactly what it was supposed to do. And the third engine...
Well, the third isn't really an engine. It's more of a lack of an anchor. We call it the one-off factor.
The ghost of 2024.
Exactly. Do you remember our deep dive into the 2024 results? We spent a lot of time discussing that massive RM 473.8 million impairment charge for the Hong Kong operations.
I do. That was the goodwill impairment, basically admitting that the Hong Kong business wasn't worth as much as they thought on paper. It was a painful episode for them.
Right. That charge dragged down the 2024 numbers significantly. In 2025, that charge is gone. It didn't recur. So simply by not having that massive hole in the balance sheet this year, the pre-tax numbers look much cleaner and much healthier.
It's like running a race without a backpack full of rocks that you were carrying last year. You're going to be faster even if you aren't actually running harder.
Exactly. But we shouldn't just gloss over costs either. Operating expenses did increase by about 6.2%, mostly due to personnel costs. They're paying their people more, which is expected in this inflationary environment. But because revenue grew faster than costs, the efficiency is still very much there.
Okay, so high-level summary before we go deeper. The backpack of rocks is gone, the insurance arm is booming, and they lent out enough money to beat the interest rate cut. That sounds pretty solid.
It is good, but the devil is always in the details. We need to look at where the money is actually coming from sector by sector.
Yeah.
Because if you look closely, one key pillar of the Malaysian economy seems to be shaking a little bit.
Let's do that. Segment 2, the sector deep dive. Let's start with the fortress. Retail operations. This is their bread and butter, right? Mortgages, personal loans.
This is the core. If this fails, the entire thesis fails. But it didn't fail. Retail operations pre-tax profit rose 5.2% to RM 4.68 billion.
RM 4.68 billion just from retail.
That essentially proves the defensive thesis, doesn't it? Even if the economy is wobbly, Malaysians are still buying homes and paying their mortgages.
It does. It shows that the consumer segment in Malaysia is resilient, and Public Bank is the bank of choice for that segment. However, there is a mystery in the data that we need to unpack. This is where the shaking pillar comes in.
I love a financial mystery. What is it?
It's the hire purchase segment, car loans.
Oh, right. I saw this in the notes. The pre-tax profit for hire purchase dropped by a massive 36.5%. It went down by RM 382.9 million. That sounds catastrophic on the surface. Did Malaysians suddenly stop buying cars, or did everyone stop paying their car loans? Neither, actually. And this is why you have to read the fine print in Note A22 and the performance review. It wasn't a collapse in lending, and it wasn't a sudden spike in bad debts in the way people usually think. It was a lower write-back of loan impairment allowance.
Oh, lower write-back of loan impairment allowance. That is a mouthful of jargon. Can you translate that into human English for us?
Sure. Imagine you have a rainy day jar in your kitchen. In 2023 and 2024, the bank was terrified of a recession, so they put a lot of money into that jar to cover potential bad loans. They treated that money as an expense on their books. But then people actually paid up. When those people paid up, the bank could take that money out of the rainy day jar and put it back into profit. That's a write-back.
I see. So in 2024, their profits were artificially boosted because they were raiding the emergency jar, or rather, they didn't need the emergency jar anymore, so they got a windfall.
Exactly. It was a sugar rush.
Yeah.
In 2024, they had huge write-backs. In 2025, that situation normalized. They didn't have that extra pot of gold to recover. So the profit looks like it dropped 36%, but really it just went back to normal levels after an artificially high year.
That makes so much sense. So it's not that the business is failing, it's that the bonus from the pandemic recovery is over.
Precisely. It shows that the massive boosts from post-pandemic recovery are fading. We are now in the new normal. No more free lunches from old provisions.
Okay, mystery solved. Now let's talk about the big winner, general insurance. We touched on this, but the numbers are wild. Profits skyrocketed more than 100%.
From RM 33 million in 2024 to RM 393.6 million in 2025.
That is incredible. And this connects back to our 2024 deep dive on the LPI Capital acquisition. We asked back then, is it worth it?
And the answer is a resounding yes. But again, context is key here. The 2024 figures only included 1 month of LPI's results, because the acquisition happened very late in the year. FY2025 includes the full 12 months.
Ah, so it's an apples to oranges comparison in terms of the time frame?
It is. But it validates the strategy entirely. They bought a cash cow. This diversification is working perfectly. It's providing a massive buffer against the fluctuations in interest rates. Think about it. If they hadn't bought LPI and they didn't have this RM 390 million boost burr, that 1.1% net profit growth for the whole bank, it would have been zero, maybe even negative.
That is a crucial insight. The insurance arm essentially saved the growth narrative for the entire year.
It did. It's the diversification engine firing on all cylinders.
Let's look overseas. Hong Kong. You mentioned the impairment is gone. But is the business actually making money over there now?
It is. Overseas operations swung from a loss of RM 130 million in 2024 to a profit of RM 452.7 million in 2025.
That is a huge swing.
It is, primarily because of the non-recurrence of that impairment. But it signals stability. The bleeding has stopped. They aren't setting money on fire in Hong Kong anymore. It's not necessarily a high-growth engine yet, but it's no longer a liability dragging down the whole ship.
Stability is all we asked for from the defensive giant. Okay, so we have the sectors. But what about the moat? Segment 3, the defensive moat, asset quality, and capital. This is what Public Bank is famous for. This is their identity.
This is the DNA of the bank. Without this, they're just another face in the crowd.
In previous episodes, deep dives, we talked about the golden ratio, the gross impaired loans ratio, or GIL. We were absolutely obsessed with that 0.52% number. The industry is usually over 1.4 or 1.5%. Did they hold the line in 2025?
They absolutely did. As of December 31st, 2025,
the
GIL ratio is essentially unchanged at 0.51%.
0.51%. That is, it's almost statistically impossible for a bank that size.
It feels that way. The industry average is hovering around 1.37% to 1.42%. Public Bank is nearly 3 times better than the competition.
How do they do that? We ask this every time, but in a year with economic headwinds, how do they keep it that remarkably low?
It's the culture. It's the underwriting. They don't just lend to anyone. They lend to people who have collateral, people with rock-solid track records. And when things get tough, they work with borrowers very aggressively to ensure repayment. They're proactive. They don't wait for the default. They call you 3 months before you default. This 0.51% is the ultimate proof that the defensive giant identity is perfectly intact. Even when the economy wobbles, their borrowers pay up.
That is reassuring for anyone holding the stock. Now let's look at the liquidity. Loan growth versus deposit growth.
Gross loans grew 5.1% to RM 445.8 billion. Deposits grew 3.2% to RM 447.1 billion.
Wait, so loans grew 5.1%, but deposits only grew 3.2%. That means they are lending money out faster than they are bringing it in. Is that a problem?
It's a tightening of liquidity, certainly, but their loan-to-fund ratio is still at a very healthy 84.1%. They have plenty of room to maneuver.
Yeah.
But it does show that finding cheap deposits is getting harder. The competition for deposits in Malaysia is incredibly fierce right now. Digital banks, other incumbents, everyone is fighting for that cash.
That brings us to the cash they do have, the capital strength. We always talk about Basel III and capital ratios when we look at these banks.
Right. The CET1 capital ratio is standing at 13.9% after deducting dividends.
And for those listening who don't have a PhD in banking finance, remind us what that means in practical terms.
It means they have a massive safety cushion. Regulators require a certain amount of capital to ensure the bank doesn't collapse if things go drastically wrong. Public bank holds way, way more than that minimum requirement. We call it strategic dry powder.
Dry powder. I like that. It implies they're ready to fire a shot.
Or build a bigger castle. This connects directly to our Q3 discussion. They are sitting on so much cash. The question is, what do they do with it? Do they use it for growth, like another major acquisition? Or do they give it back to us, the shareholders?
Which is the perfect segue to segment 4, shareholder returns. The dividend check.
Everyone's favorite segment.
So the announcement dropped on February 25th, 2026. What did we get?
Public Bank declared a second interim dividend of 12.0 sen per share.
12.0 sen. And for those getting their calendars out.
The ex-date is March 11th, 2026, and the payment date is March 26, 2026. So if you own the stock before March 11th, you get paid.
Let's put that 12 sen in context. How does it compare to the past? We call this the historical trial.
It's a clear upward trend. Let's look at the recent payments. In February 2025, a year ago, they paid 11.0 sen. In August 2025, the first interim was 10.5 sen. Now we are at 12.0 sen.
So the total for FY2025 is 22.5 sen.
Correct, compared to FY2024, which was 21.0 sen.
So 21 sen to 22.5 sen, that is a solid, measurable increase.
It is. It confirms the stock as a compounder. We've said this before. Public Bank is not a get-rich-quick scheme. It is a get-rich, slow and surely play. It's an annuity that just keeps growing year after year.
I think a lot of listeners appreciate that stability. In a world of crypto crashes and volatile tech stocks, getting a steadily rising paycheck from your bank stock is quite nice.
It's the sleep well at night factor. You don't have to check the ticker every 5 minutes.
Okay, we have analyzed the numbers, the sectors, the moat, and the dividends. It is time for the verdict. Segment 5, the financial moat scorecard and the paradox.
Moment of truth.
In our Q3 deep dive, you gave Public Bank a financial moat score of 9 out of 10. You said it was nearly perfect. After seeing the full FY 2025 report, the 1.1% net profit growth, the OPR impact, the 12 cent dividend, do you stand by that score or does it change?
I am maintaining the score at 9 out of 10.
You're sticking to your guns. 9 out of 10. Justify it for us.
The justification is in the structural advantages that simply haven't changed. Number one is cost leadership. Their cost-to-income ratio remains industry-leading. Even with personnel costs rising, they are more efficient than almost any other bank in the region.
Right.
Number two is asset quality. That 0.51% GIL ratio is untouchable. It is a fortress wall that competitors just cannot breach. And number three is the LPI success. The integration of the insurance business proves management can execute strategic pivots effectively. They aren't just sitting still. They are making smart, calculated moves. Those are very strong points, but I have to ask the obvious question. Why not 10 out of 10? What is missing from this picture? The boring factor. Or more accurately, the growth factor. Look at the higher purchase dip. It shows vulnerability in saturated markets. There's only so much car financing you can do in Malaysia before you hit a wall.
Right. Everyone already has a car.
Exactly. And the bottom line, 1.1% net profit growth. In a world where tech stocks or emerging market plays are growing at 20 or 30%, 1.1% is meager. It is a mature stock. A 10 out of 10 moat implies infinite pricing power and growth potential. Public bank has the safety, but it hits a ceiling on growth because it already owns so much of the domestic market.
That is the paradox, isn't it? We have tracked this for a year now. In Q1, we were optimistic about recovery. In Q3, we were genuinely worried about the OPR cuts squeezing their margins. And now the final view is what exactly?
The final view is that public bank is a victim of its own success. Think about it. The market price is an absolute perfection for this stock. When public bank delivers excellent stability, 0.5, 1% impaired loans, and solid dividends, the stock price doesn't jump 10%. Why? Because excellence is the baseline expectation. If they had 1% impaired loans, which is still way better than average, the stock would crash because it would be seen as a failure for them.
That is a really tough spot to be in. You have to be perfect just to stay steady.
Exactly. Public bank is like a premium bond disguised as a stock. You hold it for safety, not for fireworks. If you want fireworks, go find a small cap tech stock. If you want to make sure your capital's there in 10 years and growing just faster than inflation, you hold public bank.
A premium bond disguised as a stock. I love that description. It really sums up the entire investment thesis perfectly.
It does. It explains why the dividends matter so much to the shareholders. Since the stock price might not double overnight, the real return comes from that steady cash flow.
So let's wrap this up. We're looking at the conclusion of our year-long deep dive summary. Record pre-tax profits of RM 9.54 billion. Dividends are increasing to 22.5 cent total. Hong Kong has stabilized. The insurance arm is booming. It sounds like a very good year, all things considered.
It was a year of consolidation and strategic proof. They proved the LPI deal worked beautifully. They proved they could handle an OPR cut without falling apart. They proved the Hong Kong impairment was a one-time thing.
But we can't let you go without a final provocative thought. We always like to leave the listener with something to chew on after the deep dive. We talked about that strategic dry powder, the massive excess capital, the CET1 ratio sitting at 13.9%.
Right. They are sitting on an absolute mountain of cash.
So here's the question for you and for our listeners. With capital ratios this high and a domestic market that is fully saturated, how many more mortgages can they really write in Malaysia? Growth is getting incredibly expensive to find. Public bank is safe, yes. But are they too safe? Will 2026 be the year they are forced to make a massive, risky overseas acquisition just to move the needle? Or will they simply accept their fate and become a dividend annuity for the next decade?
That is the billion ringgit question. Is safety enough in a world that constantly demands growth? If they don't buy something big, they have to give that cash back to shareholders. We might see special dividends. But if they do buy something big, say in Vietnam or Thailand, they risk that defensive giant reputation. It's a massive fork in the road for the management.
Oh, fork in the road indeed. Do you stay the premium bond, or do you try to become a growth stock again and risk it all? We will have to wait and see what 2026 brings for them. But for now, if you have followed us through this year-long deep dive into public bank, from the Q1 optimism to the Q3 OPR crunch, and now the FY2025 finale, thank you.
It's been a pleasure dissecting these reports with you all.
Please smash the like button if you enjoyed this detailed breakdown. It really helps us out. Comment below. We really want to know your thoughts. Do you think 12 cents is enough? Are you holding for the dividends, or are you selling to find growth elsewhere? Let us know.
And subscribe to support more forensic financial deep dives like this one.
We will see you on the next deep dive. Take care, everyone.